this video, we're going to review journal entries that are necessary to prepare when a company declares a stock dividend. A company might declare a cash dividend, but they could also declare a stock dividend. And that's what we have for this problem. The board of directors declared a 20% stock dividend to be distributed on June 1st to the stockholders of record on May 21st. The company has 1 million shares authorized. These are authorized to be sold, and 650,000 shares of $12 par value common stock outstanding, and the market value is $25 per share. We are to record all the necessary journal entries. So let me remind you, when it comes to dividends, there are 3 dates that we have to be aware of. The first is the date of declaration. On the date that the board of directors declares a dividend, a liability is created and the company must recognize that liability. On the date of record, someone is going to investigate and see who actually owns the stock on that date, because those are the people who will get the additional stock or the cash dividend. And then on the date of payment, either the check is sent out for a cash dividend, or in this case, the stock is distributed. So let's see how you would go about calculating this. So there are 650,000 shares currently outstanding. So those are the folks that are going to get some additional shares. For every 1 share they own, they're going to get 20%. So 650,000 shares times 20% more would be 130. There are going to be 130,000 more shares to be issued. 130,000 shares are going to be valued at the market value on this date, May 1st, which is $25 per share. And then on May 1st, you see our journal entry. So we're going to record the stock dividend for that full amount, $3,250,000. We will put an amount in the common dividend distributable. This is like our liability for the company. The 130,000 shares times the par value. This would be $1,560,000. Then we have an overage. The market value is $25. The par value is $12. So that's a good bit more, a premium if you want to think of it that way. We will use this special account we call a PIC account. This is additional paid-in capital in excess of the par value for common stock in this case. It is equal to the full amount of the dividend, the full value of the dividend, $3,250,000, minus the common dividend distributable. The difference is the $1,690,000. May 21st is the date of record. There is no journal entry required on that date. And then on June 1st, now we're ready to actually distribute that common dividend. So we will debit the common dividend distributable account for that value, $1,560,000, and we will credit the common stock account for that value, $1,560,000. So please note, so there were 650,000 shares outstanding. Now there are an additional 130,000 shares. So altogether, there are now 780,000 shares outstanding for this company.